and thank you for joining us today. We've got an hour of great material. We're going to be talking about self-directed retirement accounts and what you can do with them, how you can source different investments. But the primary focus of this presentation today is starting businesses with a retirement account. So the process is called a rollover business startup, and by the end of this, I think we'll probably get you some good information, give you the basics of how to do stuff, some examples at the end of what you can do with it. But sometimes we're going to define the difference between an investment and a business also. But anytime we've got a situation like we're in right now, people sort of changing jobs and all, there's opportunities out there to get access to funds that you normally wouldn't have access to. And what I mean by that is retirement accounts. If you're happily employed, your current employer account, if you're under 59 and a half years old, you're not going to get access to your 401k funds. So 59 and a half, you can take in service distributions, you can get access to that money. Otherwise, it's going to require a step away from the business in order to get access to those funds. So my name's David Moore. I'm with IRA Advantage. My background is actually real estate investment. 30 years ago, my brother and I, Tom, put a company called Equity Advantage together to handle tax-deferred exchanges. And during the ensuing years, we just had many of our clients wanting to further utilize their retirement accounts, go out and leverage into, diversify further into real estate. And so we learned the basics of the IRA investment world, IRA 401k, self-directed world. And one of the sort of the byproducts of our venture when we put IRA Advantage together in late 2000s, when we put that company together, we were just going into the hardship 07, 08. And all of a sudden we were faced with clients not only obviously wanting to deal with hard assets, tangible assets with the retirement accounts, but we had people coming to us that were just looking for that olive branch to the future. And what I mean by that is if you'd lost your job in that point in time, money was hard to get, period. And so, for many people, the only funds they had access to was retirement funds. And so the rollover business startup process, or ROBS as it's called in the industry, sort of was a byproduct of, once again, our clients' demand or additional new clients' demand at a future. And so this process became part of the portfolio of products that we offer today. But once again, David Moore, IRA Advantage. I want to also stress that this is going to obviously be recorded. It'll be up on our YouTube channel. So if you miss or you've got somebody else that you'd like to have see this presentation, you can always look it up in the future on YouTube. Just type in IRA Advantage, self-direct IRAs, and you're going to get to our portfolio of information there. And if you've got interest in real estate transactions too, take a look at Equity Advantage's, once again, YouTube channel as well. And you're going to see topics, all kinds of things, not just real estate oriented, but we've got everything from charitable remainder trusts on there, cost seg studies, even life insurance contract investments. So, or sales. But anyway, if you've got a topic that you'd like some more information on, you'd love to see us present, don't hesitate to reach out. You can contact us at cmoore, C-M-O-O-R-E, at IRAadvantage.net, cmoore at IRAadvantage.net, or cmoore at 1031exchange.com. So let's get started. If we're looking at the term self-directed and what's going on in that space, self-directed is not a legally defined term. It's just a term that describes an account that allows you to go do what you want to do. And this is not new. I mean, retirement accounts came into play in the mid-70s, and the rules have not changed. It's just a very well-kept secret. So once again, self-directed, not a legally defined term, just describes an account that allows you to go out and invest the way you want to invest. And that's something that lots of times we advertise on the radio, and we always stress that we've got truly self-directed retirement accounts. And we hear see ads on TV all the time where people are talking about some companies offering a self-directed IRA. And if it's offered by one of the major Wall Street firms, it's not a self-directed account. I mean, it's one that's going to allow you to go buy what you want off of their offerings, their menu of offerings. But a truly self-directed account is going to be an account that allows you to buy literally anything the law allows. And that's a very, very, very broad menu of offerings out there. So when we're looking at self-directed accounts, we've got a variety of options out there, everything from a basic self-directed IRA, checkbook IRA, 401k plans, and then we combine those things with a different, different type of entity if we're looking at providing some type of investment vehicle. If we're looking at IRAs, for example, typically, a checkbook IRA is simply the combination of a self-directed custodial account and a IRA-specific limited liability company. A basic account just means you're moving money from a custodian, won't allow you to do what you want to one that does. A 401k plan, if you're looking at one of the plans that we put together, typically our plans are going to allow you to buy anything the law allows. So they're, once again, totally self-directed. You have the power of the pen. They work just like a checkbook IRA. And if we get to, once again, starting a business, we're going to combine a retirement account and a C corporation because that's a structure that's required to get it done. But we provide the investment vehicle to get you where you want to go. We don't sell investments. We really try to stay out of any of that space, and we don't provide investment advice. Obviously, if you've got questions on what you can and can't do, we're going to help you with that. And our main objective is we don't want to see our clients have problems with these things. And understand when you're looking at a truly self-directed retirement account, if you're looking at a solo 401k, for example, they're self-trustee plans. If you're looking at checkbook IRA, both those vehicles, solo 401ks, checkbook IRAs, you've got the power of the pen to make the investment you want as you want. And so there's really very little in the way of a safety net. If you've got a Wall Street investment, retirement account, there's a safety net there. You could make a poor investment, but you're really not going to have an opportunity to commit a prohibited transaction. When you're in our space, that is a possibility. So these are not right for everybody. You've got to be diligent about what you're doing, and you've got to look at, if you've got a checkbook IRA, anytime you pull out that checkbook, you've got to think about what you're doing with that and make sure it's something that's going to fit your need, fit the law and your needs. But really, every time you pull out that checkbook, you can say, okay, what am I writing this check for, and who am I writing it to? And we've got to be careful. But it boils down to two basic things, and really it's what you want to buy and who you're transacting between or for the benefit of that's really critical. So even though it's easy to get lost in the weeds in this stuff, if you always just stop, I'm a certified dive master. I don't do much of it anymore, but I used to do a lot of it. And the general rule is you plan the dive the plan. You look at the stuff, you plan ahead, make sure you're getting ready to go do what you want to do. If you're a pilot, you're going to do the same type of stuff. If you've got a big boat, you're going to do that. Even river rafters file a float plan. So the idea is think about what you want to do, plan it out in advance. Don't leave this to the last minute because it takes time and it requires some planning. You need to look at what you're doing and understand what you can and can't do. And then anytime you're looking at one of these investments, really think about what's going on with it. But it's not complicated, but it's just something that you really need to be diligent to make sure you're doing the right thing with. So I just sort of referenced it's pretty easy, okay? So when I'm looking at a retirement account, if I've got a self-directed account, there's two big questions. What do you want to invest in, and who are you transacting between or for the benefit of? That's what it really boils down to. Now, as I said, I've got a sister company, Equity Advantage, 1031exchange.com, that handles tax-deferred exchanges. If we're looking at that world, there's four basic cornerstones. It's got to be an exchange. What's going to receive have to be of like kind. For total deferral, you need to go across or up in value and equity. And finally, we have to have continuity vesting. Now, that code's 100 years old, and even after 100 years, there's so much misunderstanding there. But once again, only dumb questions when you don't ask. But if we're looking at retirement accounts, I'm looking at these two pillars here. What do I want to invest in, and who am I transacting between or for the benefit of? As far as what you can buy, you can literally invest in anything other than collectibles, life insurance contracts, or stock in a sub-S corporation if we're talking about an IRA. 401k plans can invest in anything other than collectibles. So it's very rarely a question whether a given investment's going to be suitable. It really boils down to who you're transacting between or for the benefit of. So any transaction between or for the benefit of a disqualified party would constitute a prohibited transaction. Don't do that. Prohibited transactions are not good. With an IRA, for example, a prohibited transaction would deem the entire account distributed as of the first day in the year in which the indiscretion occurred. 401k plan's much more liberal punishment there. It's just the money involved with the indiscretion. But you've got to understand that, depending if this indiscretion occurred before you're, 59 and a half, for example, you're going to pay normal income tax on that conversion, and you're going to have a penalty of 10% on top. If you're 59 and a half, then you're entitled to take things out, so you're going to get rid of that 10% penalty, but it's still going to be treated as a distribution. So once again, IRAs, very bad. It in fact converts the entire account as of the first day in the year in which the indiscretion occurred. And that's why if you're working with us on a self-directed IRA, checkbook IRA, for example, and we're going to say, look at diversification, your Wall Street advisor is going to tell you diversification is your best friend. What I'm going to tell you is keep the money that you want to keep in Wall Street with your current advisor, move what you want to use in the self-directed world in the new self-directed account. Obviously, it's easier to shove it all in the self-directed account, especially if we're talking about a checkbook IRA, and you could just open a trading account in the limited liability company's name and EIN. But the problem with doing that is if it's part of the LLC, it's encumbered by that account. If we segregate the account into a secondary, or just keep the Wall Street account intact, that money's isolated from the self-directed account. So just move what you want into the checkbook IRA. That way you're keeping the Wall Street stuff protected, isolated from what you're doing in the self-directed world. With a 401k plan, that's not necessary because it's not going to encumber everything in there. So with the 401k plan, typically, no matter what, what's going on, we're going to roll funds into the 401k plan. You can just go open that trading account back with your financial advisor in the plan's name and tax ID number. But these two issues are the big ones. What do you want to invest in, and who are you transacting between or for the benefit of? And the great thing about a self-directed retirement account is you literally have the ability to invest in anything the law allows. So why are people doing it? I mean, I've done very well in Wall Street over the years, and especially the last couple of years. But we all know. I mean, it drives me crazy. I mean, every morning I get up, I take a look at what's going on with the stock market. It was really unnerving, obviously, in the mid 2000s. But if you look at the world right now, the Wall Street's had quite a run. But there's concerns there, and the thing is that one of the objections that Wall Street has for you to self-direct money into a self-directed account is lack of liquidity of a lot of tangible assets. And obviously, if you're buying real estate, it's not necessarily liquid. If you're putting things into let's say the topic of today, the rollover business startup, and it actually, if you invested all the money into the business and you now hit 72, you've got to take distributions. It's got to come from someplace. So a lot of times the easiest way around these things, if you don't have cash in the account to take a distribution, if we're talking about an IRA, for example, a checkbook IRA, the easiest solution to that is just doing an in-kind distribution. You just do an assignment of membership interest in the checkbook IRA LLC. If you're looking at a rollover business startup, the easy solution is just to do an in-kind distribution of shares of the corporation. So that's typically something that people want to do over time anyway. But there's always a solution, and once again, the only dumb questions when you don't ask. So if you've got concerns, questions on different things, call up. It's tax law. I mean, there's very rarely a situation where you've got a black and white answer to things. So why do people do this? Tired of the stock market's roller coaster, greater financial control, invest in what you know. Think about that. Martha Stewart, I'm not her biggest fan, but you think about, is she the biggest culprit in insider trading? I'd say definitely not, and yet they make a poster child of her. So if you have specific knowledge of something in Wall Street, or let's say you're doing today's topic, the rollover business startup, why not use the money in something reduce the risk, eliminate the risk if possible. So, investing in what you know, if you've got insider information, specific knowledge of something on Wall Street, typically that's not going to be something you can use unless you're in the House or the Senate, right? But if you're looking at the self-directed world, if you're a mortgage broker, you want to self-direct money and loan it, you can do that. If you're a real estate person, you want to buy real estate, do it. If you want to go out and start the business, you've got background in machining, hey, you want to do a new machine shop, do it. So it's one of those things where, especially in today's world, we've all got a lot of risk in life, and we want to reduce that, make sure we're getting where we need to be at the end of the day. Increased investment flexibility. Obviously, self-directed accounts, much broader spectrum of possible investments, literally anything the law allows. Real investments, not alternative investments. So, you know, a lot of times anything that Wall Street doesn't sell is considered an alternative investment. Why is that? I mean, can you name an older investment than gold, let's say, or real estate? I mean, those things are considered alternative investments, while everything, I mean, if you look at the crash, synthetic derivatives, those are a legitimate real investment, and yet real estate's not. So, yeah, I just think that's just a big misnomer that someday will get straightened out. Community-based investing. If you want to make a difference locally, you can do that with a retirement account. You want to invest in something locally, upgrade something, make a different, loan money to somebody that needs to do something in the community, as long as they're not a disqualified party to you, you can do that. So if you want to make a difference locally or in community-based investing, you can certainly do that with a self-directed account. Take advantage of today's opportunities. Well, you know, what is today's opportunity? Depends where you are, right? Depends what state you're in, what you do for a living, so on and so forth. So yeah, what's the opportunity today? What's it going to take to give you that opportunity so you can take advantage of it? That's what the self-directed accounts are all about, taking advantage of the opportunities you see today, and maybe it's a unique opportunity. If you're looking at the value of a piece of real estate, for example, it's always the highest, best use. Somebody, one person might think it's worth twice what the other person is, and it might be to that person. So really, it's a question of what you're going to do with these things, how you're going to make it grow, how you're going to get from where you are today, where you want to be in 2, 5, or 10 years. And that's our objective, is to help you reach those goals that you've put out there. Tangible assets, great hedges against inflation. Every day we all hear the ads for gold and silver. You know, it's everywhere on the radio, TV, so on and so forth. Well, what is, for example, real estate, or if you're gonna, you know, put a new business together? I mean, you've got hard things there, but real estate doesn't have to go up to make you money. It can go along, and you're going to have somebody else buying it if it's an investment property with a tenant in it. And you're not banking on appreciation. I was taught never to bank on appreciation, and so I don't do that. So I'm always looking at something, say, okay, what am I going to make? How am I going to make it? When am I going to make it? If I can't answer those questions, at least reasonably well, I'm not going to do it. Finally, security. Lots of concern about different things out there. You know, what's going on with the money? Where is it? How can you protect it? And, you know, in the self-directed world, you're literally putting the money where you want to put it. If you've got a bank that you love, and it's a community-based bank, you can put the money in that bank. So, I mean, it's not stuck with somebody you don't know in some place far, far away. It's literally where you want to establish these accounts. So people really like that because they can see it, they know where it is, they know the people involved with what's going on. So as I said, IRA's very, very broad definition of you know what you can buy, and it's literally anything other than collectibles, life insurance contracts, or stock and sub S corporation. Once again, 401k plans, even broader, literally anything other than collectibles. So, you know, you name it, you can probably do it with an IRA or 401k. One thing I didn't mention at the top, you've all got a menu off the right side of your screen. There's a section down there on questions. We're probably not going to get to them during the presentation here today, but if you've got questions, please don't hesitate to write them out there, and we will get to them if we have the opportunity. And if not, we'll be replying after the presentation's completed, and we'll be sending out information. If you're a real estate broker in Oregon, please reach out if you'd like CE for this presentation too. It's possible to get you that too. So anyway, if you got a question, please ask it down on that site. And if you need credit, reach out to C Moore, once again, C Moore, M-O-O-R-E, at 1031exchange.com. Thank you. So, as I said, literally, the investment rarely is a problem. So what causes issues is transactions between disqualified parties. So who's a disqualified party to your retirement account? Well, you would be, a spouse would be, parents, grandparents, kids, grandkids, their spouses, or any legal entity owned and controlling interest by one of those. Something else you might not think about is that if you've got, let's say, traditional IRA and a Roth IRA, those two accounts are disqualified parties to one another. Now, what I want to really stress is that it's a prohibited transaction to transact between or for the benefit of a disqualified party. It is not a prohibited transaction to transact along with a disqualified party. What do I mean by that? Well, if you find a business you'd like to buy, well, you could be a shareholder of the company, and we actually require it along with your 401k plan for that company. If you are buying real estate, you could be a co-owner of the property, either tenancy in common or as common members of a limited liability company. If we are doing a limited liability company, let's say, and we're typically doing that with checkbook IRAs, that checkbook IRA LLC could contain you. It could contain you and a retirement account. It could contain you, your Roth IRA and traditional IRA, you and your spouse. Any combination of things is fine. If we create that entity and it has disqualified parties as members, then the initial funding of that LLC is going to be fine. We can't have additional money coming in from disqualified parties in the future. So it is a little more cumbersome after we've put the thing together if we've got a series of disqualified parties as common members of an LLC. Now, if you happen to be, let's say, in a 1031 exchange and you want to go out and buy the replacement property and combine your 1031 funds along with retirement money, that's going to require a tenancy in common structure. The exchange will not allow a partnership interest. So the 1031 is what's going to prohibit the use of an LLC in a TIC structure. It's going to require the TIC structure if you're combining 1031 funds and IRA funds into a common investment. It's not the IRA 401k world that's requiring it, it's the 1031 world. So once again, an exchange, 1031 exchanges prohibit the exchange of partnership interests. So we've used that tenancy in common structure. But once again, if you've got something that's sort of twisted, maybe the ownership's not right, back to my diving comment, plan ahead. Don't call us up the day you're trying to get something done. I mean, obviously we want you to call, but do yourself a service and really take advantage of what's there, the knowledge that's available to you, and ask questions in advance, plan it all ahead, and then you're going to go forward safely instead of getting yourself in a bad situation. So, today's presentation is primarily on business startups and all, but just for the heck of real estate, think about this. As far as real estate, people buying, a lot of the bulk of the accounts we're putting together, people that want to buy real estate, make loans, buy notes, buy, crypto, let's say, or metals. But as far as real estate is concerned, you can buy rental house, apartment buildings, office buildings, retail centers, land, any property be held for investment. You could buy a future retirement home. So, the way that gets done is if you go out and buy a property, let's say at the beach to retire into someday, you cannot use that property, period, nor could any other disqualified party use that property until it's been taken as a distribution. So what you're going to do is you're going to invest into that property, and then you're going to do an in-kind distribution over either at one time. If it's at once, you're in effect distributing the entire equity in that property. If you're doing it over a series of distributions, it's possible to do some discounting. Obviously, there's a threshold to where that stops, making sense. So maybe if you have 100,000 or less, maybe the discounting option doesn't make financial sense because it takes some planning and you got to get your tax and legal people on board. But if it's larger assets, larger things, then you always have the ability to discount a minority interest, whether it's a distribution or if you're pulling money, let's say you've got a piece of property outside a retirement account, you want to gift it to a kid, understand you're gifting the equity in that property. So make sure you understand you've had conversations with your tax people with regard to the gift tax laws and your estate, and make sure that you're not getting stung with a big tax bill just because you gave Junior a property and all that equity in it. And once again, if we're getting back to retirement accounts, typically if in-kind distributions are occurring, if we're talking an IRA, the custodian is going to require a professional opinion of value on that property. So you can't say, gee, it's a $500,000 property, and you tell them it's $3 and you're paying tax on $300 instead of $500,000 distribution. So you got to have something if you're ever audited that you can be able to hang your hat on as far as valuations. Make sure your tax people are good with that. But it is possible to buy the retirement home. Things you can't buy. Can't buy a primary residence, can't buy a second home, can't buy a property for a disqualified party, whether it's an individual or an office building that you want to occupy. Now, the way around it for, let's say, a business property is, once again, the rollover business startup. So, I mean, you can obviously create that structure, and then you can buy a building as well as everything else that's required to run that business. So rollers, how do we create these things? If we're talking about corporate plans, any company plan situation, as I stated earlier, we can roll any of those things into a self-directed IRA. But if we're looking at a situation where you're happily employed under 59 and a half, you're not able to get access to that money. So just be aware of that. I've had people literally quit their jobs to get access to money. But during the 07, 08, I had somebody that was, they worked for Freightliner, I believe, and pretty sharp guy. And, it was before the crash, but he was convinced the crash is going to happen. And he just said, look, I can't afford to lose what I put in. He wasn't able to, I guess, go to cash in that situation. So, he quit his job to get access to that money, which that's sort of an extreme deal to have happen, but that's what he did. IRAs, as far as IRAs are concerned, we can move any IRA into a self-directed account. If we're talking about the rollover business startups we're doing today, we can't take Roth money, and we can't take beneficiary IRA, one that's an inherited IRA, and put those into the new 401k plan. But any other IRA we can take care of. And as far as if you just want to do a self-directed account, we can self-direct to any IRA. This is a diagram, as far as establishing a basic self-directed IRA, it's simply as easy as contacting a self-directed IRA custodian and establishing a custodial account. And typically they're going to have one of the forms you're going to be filling out with them is a transfer authorization form, and that allows them to go to your old custodian and say, give me the money. So with regard to getting a new self-directed basic account together, it's as easy as going online, find a custodian and filling out a form and getting it put together, and they're going to initiate the transfers. So you're just responsible with going to cash in the amount you want to move. If we're talking IRAs, once again, I want to stress you only want to move what you want to use in the self-directed capacity. Leave the other stuff with your advisor. If you're doing the 401k plans, obviously just move it, and then you can establish a new account with your advisor and the plan's name and the IN. But a checkbook IRA is simply inserting an IRA-specific limited liability company between the trust company and the ultimate investment. So we're gonna create the custodial accounts necessary to take care of what your objectives are, and then after the custodial accounts are established and funded, or during that time, we're going to create the IRA-specific limited liability company. I want to stress that you can't just use any generic limited liability company. And one of the things I run across in real estate all the time, and it's outside the retirement side of it, or not unique to the retirement side, is you got to look at the stuff and understand what you can and can't do, and be sure of what you're doing. Plan ahead, but really research it before you get started on it. Don't, for example, if you go out and you contact us and say, hey, okay, it's going to take us, if we're doing a Rob's, figure 2 weeks to get everything done. Checkbook IRAs right now, it's taken probably 2 to 4 weeks, and even if you expedite an investment with a custodian, it's taking up to a week to get done. So things are slow in that space. So you really want to make sure you've got things set up before you're ready to go do stuff. If you don't have the accounts established, and let's say if you're buying real estate, for example, you can't make an offer personally and then sign it over to the plan in the future. That would constitute a prohibited transaction. So it's really important you get things set, in advance. With the rollover business startups, there's things we can do in advance because anything that you do before we get involved. For example, I've got an example in this presentation at the end where we're talking about creating a business, and the guy was really, he needed to get things going sooner rather than later. He had money that was putting into the new C Corp, and so he went out and bought some trucks in advance, and then his personal contribution to the corporation was represented by some cash and then the in-kind of those trucks, the delivery trucks. So it's possible to get things going early, but the only dumb question, as I said before, is the one you don't ask. So call up, ask the questions, but when you're looking at that IRA LLC, it's got to be a specific operating agreement for IRA use. A generic LLC is not going to work. The other thing is that understand a lot of times we'll get involved with some transaction in the real estate world, not in the IRA world, where somebody says, oh yeah, I have an IRA or I have an LLC, for example, and all they have is the articles of organization. If you don't have an operating agreement for that thing, it's not current, you don't have an LLC. It's not going to hold water, and a lawyer's going to love to punch holes in that thing. So make sure you're doing right things. Don't take the shortcuts. Take the time, plan it out, and then work the plan. Actually, I just want to go back this slide one more time. So I just want to stress, so what we're doing is we're creating custodial accounts for each type of IRA you're moving in, and then those accounts make the investment in that IRA LLC. The member or members of the LLC, typically it's going to be the trust company for benefit of your IRA, and then you're going to be the manager of that limited liability company. So it's a manager-managed limited liability company. And be careful also, some trust companies will not allow you to be the manager of that LLC, which totally defeats the entire purpose of a checkbook IRA. So make sure if you're not working with us that you understand two things about the custodian, actually more than that, but the big things I always look at is, one, if you want a checkbook IRA, what their requirements are. Two, how are they going to charge you? Because anyone's charging you based upon the value of your account, you're going to have a problem at some point. Because especially when you're looking at RMDs, so on and so forth. I mean, and look at their fees. They're making more money if the account's worth more, so they're always going to argue that things are worth more than they possibly are. A really bad story I've got with regard to that topic is during the last crash, I had a client with $1 million note. The note wasn't worth the paper it was written on, but it hadn't officially legally gone bad yet. And the custodian, the trust company, still wanted to charge based upon the $1 million value. It was worth nothing. So I'm not a fan of that. I like, if I'm working with custodians, I like a custodian that's going to charge me based upon either a flat fee or they're going to charge based upon the number of investments you have. And understand with a checkbook IRA, you have one investment. So what are examples of prohibited transactions? If we're talking IRAs, borrowing money from it, selling. So borrowing from, loaning to, buying from, selling to, obviously any usage of those things. Management, there's we've got unreasonable compensation for management. Understand sweat equity is not okay. So you can't work on anything with an IRA, which once again throws us into the rollover business startup situation. So if you come to us and say, look, I want to go out and flip properties with my retirement account, and people call up all the time wanting to do that. Number one, I've just got to state that if you're flipping properties, that's not investment, that's a business. So if we're talking about things in the tax world, in the 1031 world, we're going to look at what's called the Klarkowski court case, 9 points used to determine dealer status. I use that same court case, those 9 points, when I'm looking at UBTI, unrelated business taxable income situations, where we'd be maybe moving an asset from investment into business, and then you're going to have that exposure. So flipping property, doesn't matter if it takes you a day or 5 years to create the value in that property. If you buy it and all you're doing is working on it, predisposition, you never held it for investment. So you might get away with it once or twice, but after that, I mean, if it's an IRA, you're going to have that unrelated business taxable income. If it's a money out of your pocket doing this stuff, you got two issues. One, you're paying normal income tax on things. You're not entitled to long-term capital gains tax, and two, you can't do an exchange. So it's really important that you're looking at these things and understanding what you're doing. Now, if you're wanting to conduct business, flip properties with your retirement account, we're going to shove you back into the rollover business startup, because with a basic retirement account, you cannot work on a property, or if you're buying a business with that retirement account, you cannot work for that business if we don't use the rollover business startup structure. So if you're looking for a job or you're wanting to work on things, any IRA 401k investment, just straight investment, you can't, sweat equity is not okay. You cannot go out and work on that property. You can do the administrative functions of management. You can't work on the thing. So if you want to work on it, you want to take compensation, we're going to move you into the rollover business startup. Loans, when we're looking at loans with respect to retirement accounts, understand it's got to be non-recourse, okay? So you cannot, if we're talking about going out and buying a property, if you were to default, the only thing the lender can do is take the asset. They can't come after you for anything And we're really going to want to sort of see that anytime we're looking at retirement accounts and investment stuff. It's got to be non-recourse. And where we have issues sometimes is the bad boy carve-outs. But understand, if you're going through a traditional, let's say, lender on a real estate transaction, for example, you're not going to be able to get from a mortgage broker typically a non-recourse loan. Easy place to look is North American Savings Bank, for example. You type in myiralender.com or iralending.com, and these are banks that specifically address these issues, and they'll finance everything from rental houses up into commercial properties. And a lot of your regional banks too will do this stuff. Understand also that a IRA 401k compliant loan is typically going to be a little bit more expensive. It's going to be a lower loan to value, think 60–65%. And it's just one of those things where it is what it is. And they're also going to want to see some reserves, because if let's say you buy a property, it goes dark, you can't just feed it with money out of your pocket. It's got to be a situation where that money's got to be in the account, be there available to make things happen. So when you're looking at money for these things, understand typically if you're making investments, it's got to be non-recourse debt. One other comment is with IRAs, you're gonna have tax exposure on leverage. And what I mean by that is, if you go out and buy a property 50% loan to value, half the income and half the gain is going to be taxable. 401k plans are not that way. That's a big difference. So what are common objections to you taking your money? Remember, it is your money. I think sometimes people forget that it's your money. It's not Wall Street's money, right? So when you're looking at these things, a lot of times you're looking at, especially if we're talking about let's create a rollover business startup, or let's say you want to go out and buy value add type properties. People say, well, gee, why would you do that with retirement funds? Because you lose long-term capital gains tax rates. Well, it doesn't really matter what you buy with a IRA or 401k plan. You never get long-term capital gains tax rates. So that's really a pointless statement, pointless conversation point. Cannot be leveraged, like I just said, totally wrong. You can leverage these things. It's just more expensive money, lower loan to value, which isn't a bad thing. And they're going to want to see reserves. But anyway, it's there. RMDs, as I stated before, one of the big objections, well, it's not liquid. So what happens? You got to take an RMD and there's no money there to take the RMD. RMDs are required minimum distributions. Again, that age at which you have to take those has been bumped to 72 years old. It used to be 70 and a half, so you've got a little bit more time there. But RMDs, it's an easily solved problem. If you don't have the cash in the account to take the distribution, you just take an in-kind distribution, which is not it's not a problem. It's actually an opportunity, and it's very beneficial. And it's one of those end games that people use fairly often with us. Finally, lose interest deductions, depreciation. Well, that's true. Anything your retirement account owns, you do not. And I guess that's what I'd like to say is, think of it this way. The best thing you can do when you're looking at using retirement funds and self-directing these things is don't think of that money as yours. If you think of it as your money, you're going to have a problem. So just think of it as Susie down the streets, her money. You wouldn't dare take her money or benefit from something she's got going on, and look at it that way with respect to these accounts. If there's a tax exposure or liability for this, let's say it's leverage, or maybe you're conducting business in the account, those things, just understand there's going to be some tax liability, and it's an additional thing to factor into the return on investment. Just know that it's there. Understand you can do these things, but it might trigger some tax exposure. So we've been talking about IRAs, the 401k plans. Anybody self-employed without employees, I'm going to shove into a 401k plan instead of an IRA. I just like them better. You've got your max contribution, can be as much as the mid-high $50,000 range. So like a SEP IRA, a solo 401k, pretty similar numbers. The solo is a little bit higher, but you can actually take that 401k plan, convert funds to Roth. You can your increased contributions, no UBIT on leverage, which is what I love. The cost of prohibited transaction is just the money involved with indiscretion. You can borrow against the plan, half what's in it to a max of $50,000. You can buy anything other than collectibles. So it's really wide open. If we're talking a solo 401k plan, the only reporting there is a Form 5500 Easy, and that's only if you've got more than $250,000 in it. You know, they cost very little to keep going, very forgiving, and they are great. They work just like a checkbook IRA. So if we do a solo 401k, you're going to have a plan. You're going to have the federal tax ID for the plan. You're going to be the trustee of the plan, and you're going to just open a bank account in the bank of your choice in the plan's name and EIN. And just like a checkbook IRA, where you write a check to go buy what you're going to do, the solo 401k is going to be the same way. You're just buying a property, buying a business, whatever you're doing. The owner of that asset is going to be the 401k plan. And once again, just remember that plan is not you, it's the plan. So just don't get yourself in trouble. I have people call up all the time thinking, gee, I need more cash flow, so I want to go do a self-directed IRA and go buy this apartment building. Well, you know, that might be a good investment for you. It might kick off cash flow, but it's not going to be yours until you take that money as a distribution. So understand that, make sure you're diligent. And one last comment on checkbook IRAs is that, you know, we're careful to the point where when you're coming up with the LLC name, we don't want you to see, we don't want you to use your name in that LLC. We want to make sure that the LLC is a situation where you see that name and you're totally clear that anything you're doing with that LLC, it's not you. Business or investment. Now, we talked about it a little bit in the context of real estate, but this is an example I often use, and you know, the tax consequences of an action. For example, so we had somebody that bought an apartment building with their retirement account. The apartment building had a laundromat in it. The laundromat was a nice additional source of revenue for that apartment complex, that investment. So in that situation, we're not really concerned about UBTI or UBIT, you know, it might be called. But now that person decides, gee, you know, I really like that. The laundromat worked well, and I want to go out and buy a laundromat. Well, now using that retirement account, you know, automated laundromat, he's not working the thing at all. So, you know, we didn't have to structure ROBS for him, but he goes out, buys laundromat. Now that's a business, it's not investment. So you're going to have that unrelated business taxable income to consider. Now that's not a reason to do something or not to do something. If you want to, you know, go out and you know, let's say you're turning properties, even if you're just managing the asset, if you're, you know, just flipping properties over and over and over again, it's UBTI. It's you know, property that's been held for business, not for investments. You're going to have some tax exposure, and like I said, don't make that decision. Oh, I can't do it because I'm going to have UBTI on it. Just understand what the tax, you know, ramification is going to be, and address that, and you know, adjust your ROI to accommodate that UBTI. So once again, don't do or not do something based upon that alone. Just understand that's another factor that's coming into play. But this business or investment stuff, I'm going to go back to that Clarkowski court case and say, gee, what's the nature of the investment in this thing? Is it investment or business? And that ultimately, you know, it's going to be up to you and your tax people what you're going to do with this stuff. So how it's going to be treated. So how about a new business? All right. I gave you the example of mattress company. Okay, we've done these things for everything from the mattress companies, real estate investment companies, obviously hotels, motels, car dealerships even. You know, and honestly, that was probably an example I should have used because I really like that. I like cars, but anyway, so you can do all kinds of stuff. And the last crash, you know, it was the olive branch to the future for a lot of people. But really, what happens with a rollover business startup, or ROB, sort of an unfortunate acronym. People love acronyms today. But if we look at the ROBS process, you're just what we're going to do is we're going to roll whatever source of funds you've got. We can't move, once again, we can't move Roth or beneficiary IRA funds into the 401k plan, but you know, any of the other IRA funds can be in there, and any of the, you know, corporate sponsored plans. We're just going to create a new 401k plan. We're going to move the money from whatever its source is into that new 401k plan. And you know, as that's happening, we're also going to be putting a C corporation together. And we're going to require that our client puts 5% of the capital into that C Corp as a contribution. So the owner of the C Corp is going to be your retirement account and you. And you don't have to invest all the 401k funds into that retirement, into the C corporation. So that 401k plan is still going to allow you to make the investments you choose to make. The plan can be drawn, depending on what your employees, whether you're going to have employees, not have employees. Understand you cannot discriminate. The owner can't say, gee, this is investment, it's going to be fine for me, but it's not for my employees. So if we do one of these for you, when the plan's being drawn, we're going to go through what you really want to be able to buy with this stuff. And if it's just you alone in the business, well, maybe that 401k plan is going to allow you to buy hard assets too. So maybe it'll allow you to buy real estate, make loans, buy notes, all this other stuff that's outside the Wall Street world. If you, and that includes, what you bought with that. So you, the owner of that business, your retirement account bought in that corporation. So, one of the ways that people, a lot of times we're putting these companies together for people that have been working their whole life, and this is their opportunity to buy this business and go ahead. And in that situation, you can't say it's okay for the business owner to make an investment in that corporation, but it's not okay for the employees to. Understand it's a brand new startup. We're going to maybe have a provision in there limiting somebody's access to participate in the plan for a period of time, but sometimes people waive that too. If you're alone in there, then the plan is probably going to allow you to buy anything you want. If you're going to have employees in there, just for the sake of your third-party administrators and so on and so forth, the cost of administrating this plan and liability, you're probably going to restrict the investments just into Wall Street's offerings. Because you just don't need the additional liability. Now, once again, if it's a brand new company, you can go in and buy shares. You are buying shares of the corporation with that plan. That's how you're funding the investment or funding the new corporation. But you can't say, gee, I fully subscribe that investment. Any employees that are participants in the plan cannot buy into that. The government's attacked that, and that's the vulnerability. One of the big vulnerabilities in this is if you restrict your employees' investment options, that's a problem for you. So what typically happens is if you're happy to have employees participate, no worries, that's fine, easy to take care of. If you don't want employees to be able to buy into your company, you're just going to make that investment unattractive. Maybe with restrictions on getting money out after leaving employment, something like that. But that's a conversation we have when we're putting these things together. And one of the benefits of a brand new company is that you can have that probationary period before people participate. If you're buying a going concern, everybody that's in that current plan, everybody working for that thing's going to be entitled to participate. And so just be aware of that with what's going on. But what you're doing is we're going to create the plan. We're creating the C Corp. You're going to have a bank account just with the solo 401k plan. It's going to be the same situation. You've got a bank account in the plan's name and EIN. We do the C Corp. You got a second bank account in the C Corp's name and EIN. The plan makes the investment in the C Corp. Simultaneously, you're making the investment in the C Corp. And now you've got a corporation that's got the funds to do what you're going to do, whether you're buying a franchise. Franchise world loves this, by the way. But whether it's buying a franchise, buying some type of business, whatever it might be, you're set to go. And now that corporation owns the asset. If you've got additional funds in the plan, as I said previously, those funds can be invested as you always have invested them. So you're not stuck having to shove all the money into the corporation. Use what you need to use in the corporation. Keep the balance of the money diversified into whatever else you want to do. Keep your Wall Street money maybe with your financial advisors, and let them do what they need to do to get you where you want to be. But this is a great tool for people looking to get ahead, or maybe they lost a job, or maybe they just this is their opportunity. They want to take a shot, go out and do something on their own. This is something that's there to help and done regularly, and it works very, very well. So we talked a little bit about the funding of the rollover business startup. This page just talks a little bit more about it. The funding, and I've got examples, different things where I gave you the example earlier, and we'll talk about it later, but in-kind contributions. So your personal contribution, the 5%, and it doesn't have to be 5%, it could be 50%, it could be 80%. Whatever money you're putting in there, the retirement account's going to have an interest attributable to whatever the investment it needs to make in it. You're going to have shares attributable to your investment, whether it's cash or in kind. So, the other source of money might be a SBA loan too. We've had, clients that go to a bank, and the banks that understand rollover business startups, they'll do SBA loans also. So you can have money coming in from a variety of different sources. You can have any number of shareholders, just like any other corporation. We just need to be careful if we've got funds from disqualified sources that we're not, initial funding is typically fine, but we don't want to have additional money coming in from disqualified sources in the future, whether we're talking about a multi-member checkbook IRA LLC or the rollover business startup. Few examples. This has been fun. We're going quick. Okay, so once again, this situation, a guy came into us, and it was a gentleman that had dreamed of owning a business, and he was looking to make changes. He was moving, and so his new home and city were in a situation where he had an opportunity. He wanted to go out and buy a franchise for a mattress company. And so he came to us, and we put the rollover business startup together. So what we ended up doing in his transaction is we had the plan buy into the corporation, obviously, and then his contribution. He went out, and it was of the essence in his situation. So he went out personally and bought delivery trucks in advance. And so when it came funding time for the C Corporation, the plan bought into it and received shares attributable to cash investment. And at the same time, he received shares attributable to his cash investment and the value of the trucks that were put in. So it was a multi-member, I shouldn't say member, but a multiple shareholder C Corporation. With he and his 401k plan in the situation, but we put them together where we've got any number of other investors coming in, and they might use tax money or qualified money meaning IRA 401k funds too. But we can, if you're just making the investment in this corp, you've got buddy that start putting one of these things together, and you want to invest into that corporation as well. We can always add you as a share, you personally, or we can add your retirement account as a shareholder of that corporation. So if you're receiving a minority interest, or you're buying into a minority interest in that thing, it could be possible that you're just helping a buddy get the business off the ground, and you want to go be employed by it too, and you just want to be it's sort of a employee-owned business of that situation. If you own a minority interest, then it would not constitute a prohibited transaction for you. So once again, you want to look at this stuff, plan ahead, understand what it's going to take to fund that corporation. And it could be any number of investors. Obviously, if you're needing more money coming in the future and the funds are not from disqualified parties, it's easy to shove additional money in, as I stated, either via retirement funds or cash funds or in kind. Second example, okay, this is a fun one. Anybody, I always laugh at. I like cars, I like boats, but could you buy a boat with a retirement account? Probably not. But could you buy a charter business that had boats? Yes, you could do that. So in this situation, what happened? This is not a pleasure fishing company that we put together for this gentleman. We put a commercial fishing business together for him. And so he ended up going in and buying several big commercial fishing boats and starting the corporation, the business up. And when we're putting this thing together, once again, one of the questions that we've got in our intake forms is whether or not you're going to want to allow employees to participate, or you're going to require them to have that probationary period. And in this situation, he just said, no, anybody can participate right away. And we told him, well, look, a lot of clients just don't want their employees buying anything. And he just started laughing because I haven't done this. We probably, a lot of us have seen all those fishing shows in Alaska, the most dangerous catch. But if you're looking at that, he just said, hey, most of my employees, they're there for a season or maybe sometimes a trip. Nobody's interested in being in that. They make big money quick, and nobody was going to be there very long. So he wasn't concerned about having his employees come in and taking take an interest in it. And so in his situation, it's like, look, we'll just put it together, not worry about that with respect to the structure and people's wanting to invest into that thing. So every business is unique in the way it's funded, put together, and who the shareholders are. Okay, people came to us. They'd you know, that's amazing. Some of these flip companies, oh, come to our free seminar. Well, okay, these people came in and they'd spent $20,000 plus with the flipping school after their free seminar. Okay, so you know, understand what it's going to take, what you're going to learn, and you know, through these things, and make sure it's worthwhile. Well, the first question was, and I guess the company had implied they could pay for that school using the retirement account. That's personal benefit. Now, you know, it might have been possible if we're doing a rollover business startup, they didn't want to do that initially, and we ended up having to shift gears into it. So if you're using a checkbook IRA, you can't pay for that education. Maybe if you're training employees and all, and they're going to go through that school, and that's all part of the initial, you know, funding of this C Corp, maybe it is okay. But you know, once again, flipping properties is a business. Okay, and the biggest problem with IRAs or 401k plans, you just look at those things, buying these things, sweat equity is not okay. You cannot work on a property owned by your IRA or by your 401k plan, period. So if you're doing something where you want to actually flip properties, you want to take compensation for flipping properties, you want to go work on those properties, we're going to do a rollover business startup for you. And you know, once again, we create the plan buys the corp, and then the corp's the one that's buying all those properties. And just because we've got a rollover business startup doesn't mean every property you own has to be owned by the C corporation. Once again, you've got that opportunity where the 401k plan itself can make other investments, whether it's Wall Street or any other you know, self-directed investment you choose to make. So once again, I would keep money in the plan, allowing you to do what else you want to do. Next example, we had somebody retired actually from Intel, and he was somebody, his family been you know, in this area for decades, generations, let's say, and they had some background in mining. And so, you know, he saw an opportunity. He was done with the tech world, wanted to retire. So what he wanted to do is go out and buy a gold, silver, palladium mine. So we put the rollover business startup together for him, and he rolled his previous employer 401k plan into the new 401k plan, bought the corp went out and bought the mine. And you know, it's a pretty interesting thing. I honestly am curious how he's done through the years. This is about 8 years ago we put this together. I need to reach out and see how he's done with all that stuff. But it was pretty neat just to see the pictures of the mine. We saw, you know, what he was doing and you know, where it was and what he was getting with it, what the history of the mine was. So it was pretty interesting. But it was one of those things where he'd always wanted to do it, and this was his opportunity to make it happen. So he took the jump, and you know, and away he went. So you know, once again, that's probably not something most of us would be doing, but that was an opportunity, something he knew. Once again, invest in what you know, and that was something that he understood, and he felt that he was reducing his risk of investment dramatically by taking that action, and it was something he was very interested in doing, period, just because he enjoyed it. This sort of wraps it up. I just love this example. I give it every time I give a presentation on this stuff. I even give it out in the 1031 presentations I do, because not only did our investors get an investment, but they got a job and a place to live. So what happened is an older retired couple came to us with the idea they wanted to go out and buy a mobile home RV park. So typically, you know, we'd be in a situation where we just create a new checkbook IRA. We'd roll both their funds into their retirement accounts into that new checkbook IRA LLC, and then the LLC would go buy the asset, and now they've got a nice investment. Well, after they told us they wanted to buy this thing, they then told us they wanted to work there, and they wanted to be the on-site managers. They wanted to live there. Well, none of that is possible with a checkbook IRA or solo 401k. So we shifted gears into the rollover business startup. We took both their retirement accounts, rolled them into the new 401k plan. The plan bought the corp bought the park, and they got a place to live, a job, and an investment. And I just think that's a great example of you know, maybe at the extreme level, what is possible using this process. But it's just one of the best things I like about what I do is I get to meet lots of interesting people, talk about a lot of different things that they're interested in. And a lot of times we're helping them get into something that they've been told they can't do forever. And it's great to see their eyes sort of light up. I certainly liked it a lot more when I could see their face too. But hopefully we'll be back to that point soon, and we'll be able to see people's smiling faces going forward. But it's just one of those things. It's another thing to consider. Don't let people just say, no, you can't do something. Look at what's out there. Look at the resources you have in today's world. Ask the questions. And we like to say we're the guys with the answers. And you've worked hard for your money. We're going to work hard to keep it yours. And that's why anytime you've got situations, you've got questions or concerns, even if you're working with someone else, don't hesitate. If you're not getting an answer, give us a call. We'll be happy to talk to you about it. There is, a few pages at the end talking about definitions. We've got this IRA investors checklist. Plan ahead. Takes 2 to 4 weeks to establish your self-directed IRA. You can purchase all types of property with an IRA, SEP IRA, Roth IRA, 401k plans, wide open. You can purchase with family members and friends. You just can't purchase from or for them. So once again, you can transact along with a disqualified party. You just can't transact between or for the benefit of a disqualified party. You can buy properties with a mortgage, not a problem. Got to be non-recourse debt. You got to make sure you're doing all this stuff from the inception correctly. Don't do things personally and then try to sign them over to the retirement account. That's going to typically constitute a prohibited transaction. We're doing the rollover business startups. As I said, you can go out and buy things that are going to be needed by the business in advance. Those things can represent your personal investment in that corporation, and it just helps expedite the process and get you going faster. Don't overextend. Make sure you got a nice cushion for reserves in there, no matter what you're doing with this money, because you need to make sure you've got enough to make that initial investment and cover carrying costs for a period of time. If you're doing a rollover business startup, by definition, it's a business startup. Don't say, gee, I need $100,000 for this thing, and put $100,000 in. Make sure you're putting enough in to cover a dark time if it occurs. Don't just sort of flippantly say, everything's going to be fine. Really be cautious with this stuff. And one of the things interesting to me when we're talking about the retirement side of our businesses, as I said, I've handled exchanges for 30 years. That's really sort of a strange business because people just send us money, right? But rarely do I see people. Rarely do they come in. And I might do exchanges for somebody for decades. I never see them. And we do a retirement account transaction, whether it's a checkbook IRA, SOL, 401k, rollover business startup, and they're in my office. And I ask them, well, what's the difference? I've worked with you for decades, never saw you. Well, this is my retirement account. So typically people are more cautious with retirement money. I look at all their money as retirement money, but the deal is people are more conservative with this stuff, and you should be, right? You've worked hard for it. You don't want it to go away. Here's a couple of our sites. Once again, IRA Advantage, putting the deal on today, 1031exchange.com, Equity Advantage for exchanges. We've got property listing site. If you're looking for investment property, you've got property you want exposure for, take a look at that site. It's free to post properties. We've got paid listings too. Finally, please take a look at our social media sites. If you are not on one of our mailing lists, please don't hesitate to reach out, get a part of it. And if you're sitting home needing something to do or having a hard time fall asleep, go take a look at some of the YouTube channels, and you've got a bunch of information out there. Thank you very, very much for your time today, and I look forward to any questions or comments you may have, and best of health to everyone. David Moore, IRA Advantage. Thank you for attending today. Look forward to talking soon. Thank you.